What's up, traders, and welcome back to the Market Barometrix Fundamental Analysis Crash Course. In this video, we're going to be talking about the financial statements. Now, the financial statements are part of the financial reports submitted by publicly traded companies, and they're going to give us an indication as to various ways to look at performance of that company and to gauge the relative attractiveness of that company. In this video, we're just going to be discussing the structure of the financial statements and what the different line items of the financial statements tell us. It's important to lay some foundation, to have a baseline understanding of the financial statements, because we're going to be using the different parts of these statements in our more advanced analysis later on in this crash course series. But as this crash course develops, we're going to talk more and more about how to use this information to identify the best investment candidates available to us in the financial markets. So without further ado, let's jump in and lay some groundwork for what we're going to learn in the rest of this video series and talk about the financial statements. First up on our list of financial statements today is the income statement. It's also known as the profit and loss report. It offers a snapshot of the revenues earned and the expenses involved in generating those revenues in a given accounting period. The specific line items on a given income statement are going to vary greatly from company to company, industry to industry, sector to sector. So I know that it can be a little overwhelming looking at financial statements like this, but when you categorize it and break things down like we have in our example income statement here, it really helps to make sense of the different parts of it. So for example, let's say that we're looking at a quarterly income statement here. That would mean that we're looking at the most recent 3 months of business operations for this company. During that time, they produced $2,135,000 worth of sales, worth of revenue. Now that's going to be the top line, the first main input into our income statement over this accounting period. From there on down, we proceed to deduct different costs and expenses that were involved in generating those revenues to arrive at several different levels of profit. So looking at our example income statement here, all the categories of profit are highlighted in red, and then all the expenses and costs that we're going to be deducting from those categories of profit are in gray. The first category of expenses that we're going to deduct from revenue is cost of goods sold. Now this is the direct cost to produce the goods and or services that generated the revenue. That sounds a lot more complex than it really is. So let's create an example to illustrate how all this works. Let's say the company in question sells skateboards, and in the most recent quarter, they sold $2,135,000 worth of skateboards. So revenue is $2.135 million. And let's say the direct cost to manufacture those skateboards was $789,000. So that's the cost of goods sold. So included in the cost of goods sold would be things like the cost of the materials to make the skateboards, the direct labor involved with assembling those skateboards, the direct costs of distributing those skateboards to retail stores, so on and so forth. So cost of goods sold refers to the direct cost to produce the good or service. And whenever we deduct cost of goods sold from revenue, we get to our first level of profitability. This is known as gross profit. In our example here, with revenue of $2.135 million and cost of goods sold of $789,000, we would have gross profit of $1.346 million, as indicated in our income statement here. So gross profit is an example of one of the types of metrics that we might want to keep track of as far as, the financial statements and financial reporting is concerned. And it's the type of measurement that we'll also be incorporating into various financial ratios. And as we get into more of that, we'll talk more about how to use that and what these kinds of things tell us. But just know that when we talk about gross profit, we're referring to revenue minus cost of goods sold. It's one of the first levels of profitability, and it's derived from the income statement. It tells us what's the direct cost of producing the goods and services that are generating the revenue for this company. The next category of expenses that we're going to deduct are operating expenses. Now this refers to the indirect cost of generating revenue. So whereas costs of goods sold referred to direct costs involved in manufacturing and distributing the skateboards that this company produces, operating expenses is going to talk about the indirect costs, such as wages for employees that aren't directly involved in producing the skateboards, right? Or how about the rent expense on the warehouse where the skateboards are manufactured? Also included in this category might be marketing expenses or other administrative expenses that aren't necessarily directly involved in producing the skateboards, but are part of ongoing business operations nonetheless. So when we deduct operating expenses from gross profit, we get to our next level of profitability. This is known as earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. You may have heard this term before, and I assure you it's not nearly as complex or scary as it might seem. But basically this just tells you how much the company has made before accounting for interest, taxes, depreciation, and amortization. So EBITDA basically just refers to profit after deducting the costs associated with generating the revenue, both the direct costs as indicated by the cost of goods sold and the indirect costs as indicated by the operating expenses. So revenue minus cost of goods sold equals gross profit minus operating expenses equals EBITDA. Now, this is a fairly important level of profitability and one that we're going to come back to time and time again throughout this video series. And why is it so important? Well, it gives you a measure of profitability as far as generating revenue is concerned. Everything from here down on the income statement is basically just accounting. So anything above EBITDA on the income statement is real costs associated with, producing the revenue. So in our example here, if we want to make skateboards, we're going to have to buy wood to make the decks for the skateboards, right? We're going to have to buy wheels, we're going to have to buy trucks, we're going to have to pay workers to assemble those skateboards. All of those things are going to be included in cost of goods sold. Beyond that, we also need to market our skateboards. We got to get our customers interested in them. And we also need to pay accountants and lawyers and executives to run the day-to-day operations of the administrative side of the business. All of those things are going to be included in operating expenses. So whenever you deduct all of those things from sales, you're going to reach EBITDA. So the next category of expenses that we're going to deduct are depreciation and amortization. Now these sound like big scary words, but I promise you this is not a big scary concept. Basically, depreciation and amortization just refer to the diminishing value of assets over time. And depreciation and amortization, as they fit into the income statement, are basically just write-downs for the diminishing value of those assets. So to make that a little more clear, consider, for example, a big machine in our warehouse that helps us assemble skateboards, right? And we paid $1 million for that machine. Well, that's going to sit on our balance sheet, but we'll talk about that later. But let's say that, we bought that machine last year for $1 million. But this year, if we wanted to sell that machine, we'd only be able to get, let's say, $800,000 out of it. So the value of that machine has depreciated by $200,000. So you don't necessarily just get to write off $200,000 in expenses from your income statement. There's a depreciation schedule and a certain amount of an asset that you can write off as an expense in a given accounting period. But in general, that's what depreciation is. It's just referring to the declining value of assets that the company owns. And on the income statement here, we can write off that declining value as an expense. Now, why would you want to do that? Well, a company gets taxed on its net income. So the more expenses that you can write off against, revenue and the other levels of profitability, the lower your net income is, the less tax obligation you're going to have. So that's depreciation. Amortization is essentially the same thing, only where depreciation generally refers to, declining value of an asset. In our example, we were talking about a piece of equipment. Amortization refers to the declining value of a loan or other intangible assets. So I don't want you to stress too much about depreciation and amortization. This isn't an accounting course. So just know that, depreciation and amortization refers to expenses associated with the declining value of assets. When we subtract depreciation and amortization from EBITDA, we get EBIT. So we just dropped the D and the A, the depreciation and the amortization. EBIT is just earnings before interest and taxes. This level of profitability is also known as operating income or operating profit, because at this point, we've deducted everything that's even somewhat associated with the ongoing business operations. After that, if we deduct interest expense, we get to EBT. That's just earnings before taxes. So interest expense just refers to the interest portion of payments made against things like loans or interest payments made out to bondholders. Lastly, when we deduct income taxes from EBT, we finally arrive at net income. This is also known as earnings or net profit. This is the bottom line of the income statement. So when you hear that term bottom line, they're literally referring to net income from the income statement. Now, this level of profitability actually becomes the top line of the statement of cash flows, but we'll get into that here in a minute. Net income is one of the most important figures because it's telling you how much profit is this company making after you deduct all the expenses associated with ongoing business operations. So the most important metrics from the income statement, in my opinion, are revenue and net income, with gross profit and EBITDA being close seconds. We're going to be referring back to those 4 levels of profitability quite a bit over the course of the next several videos. So if you're going to focus your attention anywhere, I'd focus on really internalizing what revenue, gross profit, EBITDA, and net income represent. So that's a pretty simplified breakdown of the income statement. In our example here, we were talking about a company that manufactures and distributes skateboards. In the example financial statement, in this accounting period, they had revenues of $2.135 million. We then deducted all the costs associated with generating those revenues to arrive at net income of $649,000. This number then gets carried over into the statement of cash flows. So you can see that the first top line input of the statement of cash flows is net income. So whereas the income statement gave us a snapshot of the revenues earned and the expenses associated with generating those revenues in a given accounting period, the statement of cash flows talks about the actual cash entering and exiting a business, flowing through a business over a given period. What's the difference, you ask? Well, the income statement can refer to revenues generated on credit, right? So where you might have generated $1 million in sales, maybe you only collected $600,000 in cash against those sales, and you still have $400,000 out on accounts receivable, right? People that owe you money. So the statement of cash flows helps keep track of how much cash a company has on hand, how much cash is coming in, and how much cash is going out. So we're going to breeze over the statement of cash flows a little bit because we don't focus on this statement quite as much, although we will pull some figures from it later in some of our financial ratios and other analysis. But generally, the statement of cash flows is comprised of 3 main sections. You have cash from operating activities, investing activities, and financing activities. So looking at our example statement of cash flows over here, the first main category, cash flow from operations, refers to, changes in accounts receivable and accounts payable and taxes payable. So basically changes in the levels of anything associated with credit, right? So one example of an addition to cash would be a decrease in accounts receivable. Accounts receivable just refers to the money owed to us by customers that we've already fulfilled orders for. But generally we're talking about changing levels of credit between a company and its customers or between a company and its vendors. So a decrease in accounts receivable basically just implies that we collected more cash on debts owed to us than we did extend new credit during that accounting period. So that in and of itself implies that we have an increase in cash. The next section of the statement of cash flows is cash flow from investing. Now this just refers to any cash coming or going related to investments for the company. So if our company spends $250,000 in cash on a new piece of equipment, that's gonna help us to generate revenue and that's gonna assist in business operations. That's an investment in our company. And the cash flow from investing is the actual cash leaving our hands to pay for this new investment. The last section of the statement of cash flows is cash flow from financing. So this just refers to any cash coming or going related to financing. So one example might be if we have a loan out, any payments made against that loan during this accounting period would be considered cash flow from financing. So you put all these things together and the bottom line of the statement of cash flows is going to give you the cash flow from the fiscal period. What's going to be most relevant to us is the cash flow from operations. We're going to be using that number in a handful of our different financial ratios. It's going to help us to determine the value of these companies and assess their attractiveness as investment opportunities. So cash flow from operations is the main thing to take away from this financial statement. Finally, we get to the balance sheet. Now, this reports a company's assets, liabilities, and shareholder equity, which is basically just the public ownership. It allows for the calculation of rates of return, and it indicates to us the capital structure. Capital structure just talks about where did the money to fund this company come from. There are two ways in which a company can source funds, either through debt or through equity. Debt being represented by something like taking out a loan and receiving cash, and equity being represented by things like selling shares of the company and receiving cash. So it offers a snapshot of what a company owns and owes as of the reporting period. So whereas the income statement and the statement of cash flows are focused on, telling us what came in and out of a company during a certain accounting period, the balance sheet gives us a snapshot of what a company owns and how much it owes at a given point in time. Now, it's referred to as the balance sheet because it's an equation that's literally always balanced. So it takes assets and it sets them equal to liabilities plus owner's equity. So the total amount of assets that a company owns will always be in balance with the total of its liabilities and owner's equity together. So the liabilities plus owner's equity side of the equation, that's the capital structure, right? That's the capital sourced to fund this company from either debt, which is liabilities, or equity, represented here as owner's equity. The cash raised from those two sources of capital will be used to purchase assets. And as such, those things are always going to be in balance. So, for example, on our sample balance sheet here, under liabilities, it says that we have loans equaling $160,000. So, we took out a loan, we got $160,000 from that loan. We used that money to purchase something. Let's say we purchased a new piece of equipment for $160,000. Well, that $160,000 gets added to our existing equipment and ends up on the assets side of this equation because that piece of equipment is now an asset that we own. So the asset side of the equation talks about what the company owns, and the liabilities plus owner's equity side of the equation refers to what the company owes. So we're going to leave it there for the balance sheet. I mean, we could jump in and talk about the different individual components of the main sections of the assets, liabilities, and owner's equity of the balance sheet. But again, this isn't an accounting course. This is a course geared to giving you guys a bird's eye view of what these financial statements are telling us and how we can use that information to assess the attractiveness of these companies for our investments. There it is, folks, a quick look at the financial statements. We talked about the income statement, the statement of cash flows, and the balance sheet. We went over the structure of these statements and the information that's provided by each of them and what that information means and indicates to us. So far, we've really just laid the groundwork. In the next several videos, we're going to talk about how to use all the various metrics from the financial statements to indicate to us the relative attractiveness of these companies. This information is going to help us to answer specific questions about these companies, to help us gain insights and form a narrative about the changing trends and factors that are driving the performance and share price of these companies. So stick around for the rest of the fundamental analysis crash course from Market Barometrix as we go on to describe how to use this information to make smarter investment decisions and consistently grow wealth through time. If you guys like this video, don't forget to subscribe to the channel, hit that like button, comments down below, and until next time, thanks for tuning in. We'll see you guys in the next video.